Hello students, welcome to week 2. This week we're going to be talking about itemized deductions. The Internal Revenue Code permits certain personal expenses to be deducted from AGI on the Schedule A of Form 1040 as itemized deductions. You may recall that the taxpayer has the option to deduct either itemized deductions or the standard deduction, depending on which is more. And so for many taxpayers, it's wise to complete the Schedule A to see if your itemized deductions are more than your standard deduction. Oftentimes they are. And so this is a look at the Schedule A, Form 1040. For your itemized deductions. This one is from 2013. They typically update it every year. And it's divided into the following sections. So you have your medical and dental expenses, taxes that you've paid, interest that you've paid, gifts to charity, casualty and theft losses, and then job expenses and certain miscellaneous deductions. And then there's a section for other miscellaneous deductions. And then at the bottom, you would total it up. And there are a lot of rules that go along with each of these sections. And so we're going to take a look at the medical expenses. So a taxpayer, they can deduct certain medical expenses for qualified individuals. So it has to be your dependent, or the children of divorced parents, or the taxpayer. And these are the qualified medical expenses, the diagnosis, cure, treatment, or prevention of disease, medical care insurance, transportation, long-term care, and any expense that affects structure or function of the body. And so for your diagnosis, cure, mitigation, treatment, or prevention of disease, it would include physicals, dental exam, those routine things, and expenses to cure specific ailments, but not just to improve general health. The IRS was smart in realizing that people would try to deduct things like vacation because it was good for their health. And while that may be true, not allowed as a deduction. Weight loss programs, as long as it is to cure specific diseases like diabetes or hypertension, and it was, prescribed by a physician, then that would be deductible. So always just recall that there are rules you have to follow. You can't just deduct everything. Has to be legal medical treatment, typically not prescription drugs, like supplements and health food. Those things are not deductible. Aspirin, Tylenol, that sort of thing. Band-Aids, not deductible. However, I believe they're not taxed when you go to the store. If you just go buy Band-Aids or aspirin, something like that, there's no tax there at the store. At least that's the way it is in my state. That may vary from state to state. But as a rule, those items are not deductible on the Schedule A. If you have a child that has some sort of physical or learning disability and they go to a special camp or school, any kind of medical equipment and things like that, that can be deductible. Procedures affecting function or structure of the body. So expenses are deductible if it impacts any kind of function or structure of the body. Things like eyeglasses, hearing aids. Cosmetic surgery is not covered unless it's correcting a deformity, personal injury, or a disfiguring disease. So if it's just to improve general appearance, it is not deductible. And then transportation is also deductible. So if you're having to travel, if you're sick or you're helping take care of someone that is sick and you're paying for their care, say your child, and you're having to travel, from your home, you can deduct mileage, you can deduct taxi, airfare, ambulance fees. You can also deduct amounts that you pay for lodging, up to certain limits. Also, qualified long-term care. So if you're taking care of an elderly parent, perhaps, and you're paying for their long-term care, then you can deduct certain costs related to that long-term care. It is subject to 10% of the AGI. So what that basically means is you calculate your AGI, you multiply it by 10%. And for simplicity's sake, let's say your AGI was $100,000. So 10% of that would be $10,000. So you can't deduct qualified long-term care until actually any medical expense. It's not just the qualified long-term care, it's any medical expense. You add them all together, and in this example, they would have to be more than $10,000. Okay, so the first $10,000 you can't deduct. After that, $10,001, then you can deduct the $1. Okay, so there is a 10% rule on that. And some premiums are subject to certain limitations, and the person has to have difficulty or need help performing eating, toileting, bathing, and dressing tasks, what we call activities of daily living, for at least 90 days. And then also there are capital expenditures for medical care. So if you have to install a wheelchair ramp in your home, or you have to purchase an artificial limb, something like that, then those items can also be deductible. Okay. In general, capital assets are not deductible, but there are some exceptions. Even here, if you have a swimming pool to help heal a patient's arthritis, you can only deduct that if the amount that you put out to install the pool is greater than the increase in the fair market value of the property. So there are a lot of different rules about capital expenditures. So just know some are deductible, some are not. It's going to depend, just like on a lot of things with the IRS, it depends. And then also there is the cost of living at institutions. So if you're having to pay for nursing home care, or school for the disabled, something like that, there are costs there that are covered, things like meal and lodging, and actually paying for the care in the facility. And then there are some rules, the last thing to discuss, that there are some rules about the amount and timing of the deduction. Typically, you can only deduct qualified expenses if it's in the year that it's paid. You actually have to have paid it, unless it was charged to a credit card, so it's deemed paid when it's charged. Prepaid expenses, those are deducted only when the service is rendered, unless the prepayment is required before receiving care. So some rules about that. And you can only deduct unreimbursed medical expenses. So if you're getting a reimbursement for it, you can't deduct it. And then, so if you, for example here, if you deducted $50,000 in one year, but in the next year you're reimbursed $20,000, then you have to recognize $20,000 in that second year. If it was deducted. If it was never deducted, you don't have to recognize it. Okay, so that is medical expenses. They probably have some of the most complicated rules. Remember, there are several sections on the Schedule A, and that goes on the second page of the 1040. The total of your Schedule A or itemized deductions are going to go on the second page of the 1040. They are deductions from AGI. Remember, that's very important because your tax is actually based on your deduction or your taxable income after you deduct all of the deductions from AGI. and then you will calculate up your tax. So it's important to make sure that you get all the deductions that you can. And you might be surprised when you start going through the Schedule A and how many deductions you actually have. So I want you to continue to review Chapter 7 and then answer the question that I'm going to post at the end of this video. And I will see you in the discussion. Have a great day, everyone.